Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol and Associates Asset Management.
Good morning, everyone. September 4th, MAM research meeting, back to school, back to investing, and a little bit of volatility. Let's get into it here. Contrarians, so got a little bit of an update from some of the torquier parts of the alt program. Contrarians are distressed debt specialist down in Latin America and some of the emerging markets. Looks like about 4.5% for the month and coming up on 11% year-to-date net of fees. This is a strategy that tends to, follow some of the again more frenetic parts of the market, like small caps and high yield. This is a blank screen I just put in there to see if anybody's paying attention. Alpha North is our small cap specialist with Steve Palmer. 2.5% was the strike in July, and that trailed the venture, but outperformed the big boy TSX. And so we've been talking to Steve here and there and sort of following small caps a little bit more closely in recent months. Just some company news on the sponsor side. Bridge Investment Group is one of our real estate partners. Earlier in the year, it looks like February, they got. I sent this around last night just because both of these are pubcos. The LPs that we're in, the real estate LPs that we're in are private, but the shares of Bridge trade on the NYSE, and Apollo took them out, and looks like that deal closed yesterday. So I had a chat with the key investment decision makers there. They're not going anywhere. Apollo has assured it. Okay, multiplier. So we have an older vintage fund here in the growth lending space, aka loan sharks, but I mean they do a good job. And this is again an older fund. So the fund in this case, our relationship with multiplier is getting smaller, and we're happy for it because conditions for a lot of these companies, the sort of stragglers in the fund, went through a period of higher rates and higher inflation, and now higher uncertainty regarding trade and policies and blah, 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 blah. But the point is, at the midway point of 25, this fund had a carrying value of $3 million in loans. The warrants are just under $5 million and another 1.25 in equity. They're outside of the investment period multiplier, that is. And so the only investment, in quotes, investments that they're making are essentially tacking on a little bit more money to maybe dress up some of the companies that they've still got. And the SBA, which is the Small Business Administration debentures, have been repaid. And in fact, Multiplier has relinquished the SBIC license last year in January. This is a look at the active, i.e. unrealized portfolio companies. You might know some of these. We've talked about them in the past. We're not going to do a deep dive into the individual companies today, but that's that. Looking at the Q2 commentary from Exponential Age Asset Management. This is Raul Paul's crypto asset manager. The year-to-date numbers for the fund were bad, right? So it lost about 30%. That's just sort of the reality of the world in digital assets. He puts down some benchmarks here with regards to things like the S&P, Bitcoin, Ether, and Solana. That was sort of the midway point of the year. Just for clarity, we kind of eased into this fund. We didn't get tagged with that negative 30% start, so we're not really off to on a hind foot there. And the July and early kind of whisper numbers in August are obviously a little bit better. Actually, just backing up for one moment on this, for those new to the call, there is quite a bit of a reporting lag here with this particular group, and that's that's private equity, right? If you're looking at this or someone's rent roll today, you're looking at a number from probably 2 or 3 months ago, if not more. Charts of the week. Yeah, the markets kind of dropped on Tuesday, and what Andrew's saying is it kind of took it all the way back to those late July levels. But the fact that it only represented about a 2.5% decline from last Thursday's sort of apex valuation, if you want to call it that, in his mind, I think speaks to more about the recent lack of upside acceleration than it does the dip itself. So maybe he's kind of using that word like fizzle out, and he's talking about a level of 6450 for the S&P 500. I was just getting down to our shop's monthly commentary, and I was kind of surprised about what's going on in the labor market and bond yields, and you can really see this in gold. So obviously there's people on this call way better at fixed income than me, and we'll hear from them hopefully later on. Here's the S&P 500, and it is kind of hard to see just because of the sizing of the chart, but the dip he's talking to is right here, and it literally just fell to the dotted line, which is the moving average. So not oversold, even if it felt like a big decline. It's sort of neutral, I guess, is what you can call it. And in fact, his own risk on, risk off RORO indicator still is in the positive. I'm not sure if that's due to lag. I suspect that any further downside pressure in the S&P would cause this indicator to head back down to that 4 or 5 level. Taking a look across the markets, it's kind of hard to see last that dip back on Tuesday in this chart. What is obvious, regardless of the resolution, is that gold spike up. So we talked about this. There was a couple of months long period of consolidation, and then wham, off we go to supposedly 4,000. Some say a lot more than that, and that's, I think, really I other than inorganic chemistry and the periodic table number for gold, the element, I can't claim to know much about it other than when you get a period of negative real yields or perceived negative real yields, i.e., inflation. Gold's actually going to be a real winner for you, and our investors have certainly cashed in on gold's luster, both in the long term as well as recently. So that's great. The various indicators of the markets. I looked at this chart. I looked at this series of graphs last night. I really couldn't find anything that sort of leaps out off the slide to me. Although you are kind of starting to see semis maybe trail their leadership of the S&P 500, and that's just not from Tuesday. That's sort of been going on now for a little bit. Potentially something to contemplate. In terms of the sector movements, it's really only the -5 in tech that you see here on this table, and even with that -5 change relative to last week, which is material, it's still sort of in that yellow band, not in the naughty pile there. So potentially just a resetting of risk in terms of tech. He did do a lot of work this week on the NASDAQ, and the main sort of visual from the panel is that lower RSI panel, which we talk about a lot, and Andrew points out. He's really great at pointing out dislocations between things like pricing, valuation, and the underlying sort of oomph that is leading to them. And so the NASDAQ did underperform. You can see it in the pricing chart. It failed to make that new higher high after the most recent rally, even as the overall S&P 500 did. And so there's some concern about whether this is short term or whether you're going to get some additional near term damage. He's talking about these various levels here, 21.5 to let's say 22.5, 22.650. But I think where he kind of stands is that other than the lines are shown in the picture, he doesn't see much obvious support again. So you want to be careful because on the one hand, these are sort of big, beefy support zones, but if they break, which is possible given the lack of momentum down below, you could get a bit of a sell-off, which isn't a bad thing. I know there's a lot of investors probably looking for an opportunity to pick up some of these companies. Like I noticed Salesforce fired about 4,000 people, and you're starting to hear a bunch of stuff on that. Okay. Speeding along, this is the Russell, the small cap, and a huge kind of coffee cup. I've got my cup of coffee here. This one's way bigger than that. Goes back to looks like 2022, and it was a rough patch in small caps. I know that because you saw 22 and into 23 kind of having that higher rate, higher inflation, and then the period of trade and tariffs. I think, frankly, the interest rate and inflationary side of it, I understand. What was sort of a mystery to me was, why these small caps got tagged as hard as they did on, the tariff tantrum or whatever you want to call it. I thought they were more localized, but I guess the joke's on me. Gold, so looking really good here. It's broken out, and this was a nice breakout. Looks like a credible, high profile, very visible breakout out of that consolidation range. So this should be money for our peeps. And just finishing off here. Sprotts Physical Uranium Trust. I think this is the one that got upsized from like $1 to $200 million. And it's just, it took a breather there, bounced off that downward trending line, and then just powered forward. So, I mean, this is, one of those metals that, again, we've got a big, well, not big. We've got a appropriate investment in uranium for our folks, and that's great. It looks like it's going nuclear, pardon the pun, and it's definitely a Canadian story because there's a deposit up in northern Saskatchewan that's not only one of the world's biggest, but the grade of the ore, as many of you all know, is by far the richest, and that just means that for every truckload of dirt you're scratching out of the ground or the mine there, you're getting a ton of uranium in it. Finishing off with Mr. Bitcoin here. So a lot of crypto talk, going around. It did break out over that support zone there. And Andrew did talk about this as being potentially important. But it's come back down a bit, and he's kind of in the he's definitely now more in the shoot first, ask questions later camp, in as much as he says, the markets need to prove to me, what my views should be. And with Bitcoin, he's saying it really needs to demonstrate that it's getting its groove on and repairing some of this technical damage in terms of that lower level. But as we all know, and Sean, probably the best out of all of us, this is the cryptocurrencies. This is the UFC of financial markets. No one buys Bitcoin thinking it's a a utility. And that's it for myself. Back to you guys.
Okay. September 4th, same disclaimer as the front end that Joe showed, so I'll just jump over that. There won't be a lot of movement here. It's kind of been a stagnant few weeks, or not few weeks, but recent weeks. S&P 500 increased 1 box this week. The support you can see about 5 boxes lower. Obviously there's some economic numbers that are coming out that are a little more worrisome, which could push the Fed to cut. I'll show a slide later that kind of looks at that. NVIDIA obviously beat their forecast last week. I highlighted that. I think they reported on Thursday, the day of this meeting. But shares are down about 6%. There's some China worries and growth worries a little from Wall Street investors. Overbought, oversold, large decrease, lowest in a month, and second lowest since early May. So you can kind of see demand teetering there in terms of the growth indexes. Same story here. NASDAQ kind of moved horizontal, 2 column changes back to support. But if it does fall below the next kind of 2 lines, it has quite the distance to drop before that next support line down at 20,800. Overbought, oversold, same story, large pullback, the lowest since May 9th, exact same as the S&P. So really seeing those two indices correlated. And then the Dow here, kind of the same story after it hit its the overbought, oversold lowest in 5 weeks. So kind of not as grave as a drop in investor demand, but nonetheless kind of following the same story as the 2 more growthier indices. TSX 60, this is kind of where the strength is right now in North America. We continue to see outperformance. I think the TSX 60 is up, I think close to 15% now year to date. I don't have the exact number, but nonetheless, basically cheaper valuations and investor demand, is supporting investor demand. New all-time highs this week. Again, support you can see kind of stretching out again. So 10 boxes lower. There's no real update on a trade deal, but the number here, overbought, oversold, slight increase. I noted last week it was over 100%. I think it was 101 or 103%. That was the highest since 2017. This is the new highest since 2017. And it's been extremely overbought since over the last 6 weeks. Perhaps we could see a bit of a pullback or a reversal in the short term, but we'll have to watch. The TSX, looking here at the VIX, bit of an increase week over week, new buy signal. You can kind of see it break out the VIX. Target did reverse, implying a bit of a spike in the short term for volatility. And we could also see some spikes coming in the next few weeks, obviously, with some big economic data dumps, and then closer to the middle of the month, the Fed's decision being made. Not a lot of movement in these technical indicators, so I'll be quick on them. NYSE overall moved up. Part of that was actually driven by small caps. Dorsey Wright put out a nice slide on small caps. They're still lagging, obviously, large caps, but some recent outperformance by select parts of the small cap market. Percent positive trend, these 2 charts, no movements here, very slow moving, often a lagging indicator. And then the Toronto Stock Exchange still moving upward, but still greatly lagging their 2021 highs. So you can see that the breadth, honestly, the lack of breadth amongst Canadian equity names still there, and there's potentially some more upside for the Canadian market. Looking here, not a lot of movement. Real estate and consumer non-cyclical within the sectors here in terms of relative strength buy signals. They've jumped back and forth over the last few weeks, kind of just sitting in the 8th and 9th positions over the last 6 months. No real movement. But tech has increased 23 buy signals since the middle of June. Really, the largest 2 gainers over that time have been tech and industrials within the sectors. Looked kind of over the last 4 months at all the other areas. The only large gainer was US dollar, which has picked up 4 buy signals slowly. Perhaps a bit of a reversal and a return to the US dollar after the really soft start to the year and to the Trump presidency for the US dollar. Going into a couple slides here, this is just part of the Kraft Heinz announcement. Obviously, shares have tanked since 2017. Investors don't like this kind of carve out, we'll call it. Buffett's down about 27% since his 2015 investment in the company. Remember, he took about a 20% stake through his investment in Kraft, I think, originally. This is among the worst performers in the industry over the last 10 years in terms of gross margins, profitability. And reportedly, this deal will create I think a couple $100 million in dis-synergies, according to Buffett. I think he went on CNBC or he called in or something like that this week. So really on the technical chart, looking really poor here. Number of sell signals in a row. Highlighting here, home builders ETF, obviously, since the lows of those, I guess the tariff worries from April, Trump's large announcements, his billboards that he presented on the White House lawn. We've seen a really strong rally among a lot of equity names. The home builders have really surged in recent months. Obviously, there's anticipation Fed's going to cut interest rates perhaps in September, but then a couple times after that. Predominantly do not take exposure to real estate and home builders within the public equity portion of our portfolio, but just a strong name to highlight here. And then something similar to what Joe actually reiterated, he talked about the Sprott Trust, which we own across client accounts, but we also own some miners through, well, we own a couple miners directly, but then we own the broad ETF, URNM. U.S. government obviously continuing to show its support. I think the U.S. Department of Nuclear Energy put out a nice little web page that I quickly skimmed through this week, just kind of highlighting what Trump's announced in the uranium and nuclear energy industry over the last 4 months. Kind of an interesting read. And you can see where the funding's going, what's going to happen, what their goals are. In terms of nuclear, obviously the demand is going to continue to increase, but this ETF up about 27% year to date, even more since the bottoms, and basically scoring at a 6 out of 6, despite the, we'll call it this recent pullback that we've seen over the last week. Now, what I was saying about the Fed, basically unanimous now probability that we're going to get a cut, but 96% according to the Fed Watch tool. I think this, I screenshotted this 2 days ago, so it could have changed a little right now, but really quite the change over the last few weeks in terms of this chart. But if we don't get that cut, there could be some real volatility and some downside in the short term in equity markets and even debt markets. And then I think I have 2 more slides. This is just general dynamics. I highlighted this in our weekly commentary. Obviously the defense and aerospace industrial company that everyone knows, but scores very well in terms of our technical data, but also our fundamental screening. We've been had this on a couple buy lists now. It's had double-digit earning growth over the last year. Government spending obviously driving part of that with Trump's commitment to defense, and then also his kind of ask for all the U.S. allies to begin spending on defense or their fair share of defense spending. And then right now they have about 103 billion in order backlog right now, and most of that is going to be converted into revenue. And right now, to put it in perspective, General Dynamics does about 50 billion in revenue a year. So over 2 years of backlogged orders, and they think that number could increase in the next 2 quarters. And then highlighting here, Couche-Tard, long-time holding. I think his average cost for some of our clients was very, very low in the early days of McNichol and Associates, but a really strong earnings print this week. Higher, well, I mean, it was up 6%, but it was driven by higher fuel and merchandise gross profits. Obviously, we've seen some weak share performance over the last 18 months or so, kind of since they started whispering that they were looking at 7-Eleven, and then they made their offer. Shares kind of moved lower. Obviously, that's not as much of a worry right now, but shares right now trading at 17 times forward earnings, well below peer group. It seems for now, the company's kind of back on track with their old model and not interested in that massive purchase of 7-Eleven, but we'll have to watch that. For now, we think right now perhaps a nice entry point after the pullback we've seen even this year, but something just to watch there. And then just highlighting this last chart, this is office delinquency, despite a lot of companies pushing their employees to come back a couple days a week at minimum. It seems that they're doing that by still consolidating their office space and kind of sharing office space amongst employees because people are coming in on different days. And you can see here the office delinquency rate higher than it was in the financial crisis, continuing to increase after we saw that small decrease back in 2024. And I think that's it for me.
Okay. This just came in, and Michael Coolbaugh must be enjoying his new child, because I didn't get any commentary from him this week, so I'll be briefer. Once again, this just came in. I couldn't believe that American Eagles chart that we were just shown by that NASDAQ Dorsey Wright analyst. It's up, 26%, but the chart still looked horrible. So, good for them for getting out of the basement, but retail is still in trouble. More Trump stuff, tariffs. Yeah, they're trying to find legal ways to shut them down. In my opinion, those are just going to be regional drags, and probably what will happen is he'll take it to his Supreme Court, and they'll probably down political lines and allow things to go through. Okay, some West Dome news there. We own that. Looking good. Actually, I try not to talk about stocks, otherwise we all end up talking our books, and that gets pretty tedious after a while. The breadth of the Canadian market, all sorts of precious metal names there, trying to keep this macro again. Look at the Canadian banks on the 52-week high. So I find that just remarkable with everything going on in the condo markets and so forth. But I guess their investment banking divisions are just coining it, and that more than offsets the old-fashioned banking business. Looking a little bit more balanced in the U.S. for the breadth, and you're not seeing the precious metal names there. Well, they don't really have any on their exchanges. Only a few on the S&P 500, but they're the big ones that haven't really had this impact. In terms of what the market is doing, green everywhere for the major markets around the world. Canada being the leader in the TSX Venture Exchange. Joe, we really got to speak to our small cap manager and find out why he's not keeping up to this huge number. And I don't know, maybe he'll tell us that this is all made up of gold, venture capital, gold mining companies and so forth. But still, I hope he can explain that to us before we get impatient. The S&P trying to get to double digits, NASDAQ already there, Dow, the value index, lagging behind. China's doing well. The big leader in Europe is Italy, even though you hear all sorts of debt issues there. Debt is a real problem around the world, with Japan being the ultimate leader. Even though they're trying to monetize so much of their debt, they're just buying it themselves over and over. So I don't see how that makes anything go away. So it'll be interesting to see who gets out of this first. There's all sorts of talk of crypto being one method to save it. I'd love to hear Sean Cumby later on, any thoughts he has on that, but leave that for the moment. Crude is all red. Nat gas is trying to come back around. And here's gold. Once again, we've talked about it enough. Incredible returns. 37% 1 year, 28. Like that's just blowing all the other commodities away. Silver not too far behind. Actually, maybe ahead in many cases. But still at $42, I think silver is very inexpensive. Copper trying to come back. I'll talk about the Canada-US dollar when I do the playbook. And same thing about interest rates. And then finally, just any headlines. Yeah, I love sayings like this. Choose to be optimistic. It feels better. Yeah. It's so easy to be pessimistic and negative on any subject, but always try to find the silver lining, is what the Dalai Lama is telling us. Looks like pretty broad-based headlines there. Great to not see a certain person's name in every other headline. Okay, so that's it for that. Let's go back to the playbook. So just for those who are new to listening to this, we've got about 57 points of interest here that are all sort of economic first ones are currency. Currency is probably the most important thing for direction. Now that's changed. That's a little lower. So the short-term vertical price objective for the Canada US dollar, which is at 73 cents now, is down to just about 80. I thought that read higher last week, but it's the long-term one that tends to be more precise, and it measures down to 62. So I don't see our Canadian dollar relative to the US dollar going anywhere, just sideways between 72 and 73. The US dollar spot index hasn't changed either. It's at 98, still measures up higher, even though the trend has been down 10% year to date. So we'll see on that. Yeah, crude down. This has changed. Nat gas now is measuring up. So as you could see on those greens on the others, so nat gas might be a place to make sure if we're going to have energy, we should have that. And uranium is another favorite of ours that we have not been selling. The producers measure up a bit, copper down, uranium way up again, so that's changed. Gold measures way up on the future to 3860, to the spot to 3800. So gold isn't done yet, or at least it's not taking a pause yet, even though I got through about half of Fred Hickey's report. And yeah, he gets very nervous at these toppy levels for gold. So he's taking profits here. But the reality is when you're long gold miners and that, it's too hard to trade in and out of them. So we'll just continue to hold and maybe trim a little bit later, especially with one of our positions has done very, very well. And we're waiting for some news on that. Gold bugs up, neck majors are up. And look at those juniors, 83.80 up to 125. I'd love them to drop another column in here, Ken. We should probably look at this as to what the percentage up or down is for these numbers. And these are just two data points. Obviously, the current price is real, but the future price, who knows? If this black box worked perfectly, yeah, we wouldn't probably be meeting right now. Silver up, juniors up. Platinum, that's even changed too, so that's moving up. So the whole precious metal complex is up, and same for the crypto space. Bitcoin up to 208,000, Ethereum more than a double to 10,000, 10.5. And but the index, interestingly enough, all the components looks to be about flat. Finishing up here on interest rates. So it's September 5th, I think 16, 17, I want to say, when the Fed's meeting. And that's where you're going to see this start to happen with the short-term rates right now at 3.6%, measures down to 275. So you're probably looking at them cutting about 0.5%. According to this, it'd be my guess. We'll hear from Chris Curry later, maybe on any data plots. If you have anything, Chris, just email them over and I can put them on the screen. Now you look at the 5 and 10 year measuring down to 3.1 and down to 3.9. But this 30 year still is measuring up. So you're getting a steepening yield curve with this showing me at least that inflation is still locked in the system. And yeah, that jobs report will be interesting to see what happens there. See if we can hopefully even trust the data. Yeah, that VIX trade that one of, I won't point the person out specifically, but one of you had on. Now is the time that it really looks like it could start to happen. Just don't know when. And Ken's already covered the bullish percent. And yeah, that's it for me. So I will stop sharing and maybe Sean, you want to jump in here? Maybe give us your macro outlook if you can, and even tie in the crypto space would be great.
Yeah. So can you hear me?
Perfectly.
Okay. So things are petering out right now. Like I'm feeling it kind of across the crypto space. Gold and silver was on everyone's minds at the investment dinner I was at. Not one person out of 12 of us, except me, not one of the 11 people held any crypto exposure.
That's
Right.
amazing.
And there was a little bit of talk of AI, but really underappreciated. These guys all call themselves deep value. I bought Google the other day, and the ruling came out that they didn't have to divest themselves of the Chrome browser. That Chrome browser is going to be a platform for AI innovation for the rest of our lives, frankly, right? When you get into the Google ecosystem of what they're doing, integrating AI across different products, it is absolutely astounding. Like it and probably Amazon, when they get their AI shit together, because they have a platform to deliver physical goods, they're going to steal advertising revenue from Facebook, Google, like just from everywhere. Like tech is just going to like bloom on this AI stuff. But there are definitely things that are overvalued. Like Palantir is the most overvalued company I've seen since that 3D printing craze where GDD went parabolic and then crashed down. So in crypto right now, if I'm just going to flip and look at my charts here, just following like IBIT, which is the easiest ETF to trade, it has basically been saying it's risk off, not presenting a good forward Sharpe ratio since, say, August 20th. Ether, which has been my favorite, is still holding its own, but it's traded sideways now since basically August 20th. So we're in the sideways period. Everything that Trump is doing is under attack. I'm wondering if crypto is going to come under attack, although still, like I've never seen things in an administration line better than to support this very small asset, really, of Ether. So if I had to choose, I would say own Ether. And if you had $100,000 to invest, I would say put half of it into just pure Ether and the other half probably into YETH, which is a covered call writing ETF on Ether. So anyway, that's a big picture right now. From the volatility, I did make some money. I recovered a great deal of money on that VIX move the other day. I'm still net down on my VXX position, but I've lightened up. Looking at VIX Central, like the curve is normally sloped right now. So that's saying it's not the worst time in the world to be exposed to the bottom of the capital structure. And we're seeing that across all of the equity indices right now. This morning, I had a discussion with a fund company here in Toronto, asking them like, could we do a venture TSX venture ETF? So I'd love to see that happen. I think that's, a product that's on fire. It's long overdue. Love to see that happen. When the venture runs and you look at it across momentum, it is like one of the best products out there. Like it is a momentum machine because you can't really short these small companies. And so when it runs, it tends to run hard, but there's no easy vehicle to trade like say 20 or 30 of the individual top market cap stocks at a time. Anyway, that's it for me. Happy to answer any questions.
Yeah, I just looked at that. Why it's been a real dog, but it looks like it's just starting to recover. Why did it do so poorly doing covered calls when Bitcoin had such a run there?
Well, those covered call strategies do struggle when the market is running, right? Because they're basically, getting called away constantly. So it's an issue, but the distribution yield on it is really quite high.
Yeah, but the year to date, you're down 45%. So,
well, yeah,
save you on that.
Yeah, I don't want you to go back in time and buy it, but like right now.
True, but going forward, you're saying so. The last
Yeah.
month, it's up almost 7%. So
Yeah,
maybe you've caught the bottom on this.
When you look at the price, you don't get you have to look at the total return on this, which is a big problem with a lot of the charting software is they only show
Right.
price.
Right.
So the trailing 12-month distribution yield on that YETH is 72%. And one of the guys from Maryland, who's a huge real estate investor, he said, I'm now buying these covered call ETFs, and I'll probably just replace my real estate portfolio with this going forward. Anyway.
Yeah, well, if you find a way of charting that includes the distributions, show it to me. I just asked Nasdaq Dorsey Wright to include it because they don't have it on their inventory.
Yeah,
so.
they have to include it. When you look at things like even these long-term ETFs like TLT or the high yield HYG, to look at price and not understand that coupon is just not a complete picture when you're doing your analysis.
Yeah, no, Bloomberg can do that for you. So,
Yeah.
If you have a Bloomberg terminal, that group that I talked about at the top of my speech there, Glen Orkey, they do that all the time because they look at so many dividend stocks and high yielding dividend stocks. So when you add in the dividend distribution, it's a whole different picture. So I totally agree. It's just for whatever reason the system's set up just on price only. So. Okay, that's great, Sean. Anybody have any questions before Chris Curry takes over? Thanks, Sean. Chris, any thoughts on interest rates and the Fed?
Yeah, a couple of points. I'm really glad, Sean, you introduced that topic because it sort of lets me get up on my fixed income soapbox, and people just look at price returns and fixed income as well. And I've long tried to make the case: you buy a 2-year bond, a 3-year bond, you're holding it to maturity. It's like your house. You don't care if the price of houses in Toronto goes up and down over the course of 2 years. You're holding into maturity. You're getting all your money back. And these short-term measures of quarterly performance for short-term bonds, they're irrelevant because people are holding to maturity. And what really matters is the coupon and, the cash flow from the coupon. But I'll step off my soapbox now. Interestingly, I'm sure you saw this, Dave, but Goldman Sachs is out with a report calling for $5,000 gold next year.
Oh, yeah, no, I didn't see that. Wow.
Yeah. Unfortunately, they based their argument on the somewhat spurious notion that, if 2% of people holding treasuries just bought gold, that would lead to et cetera, which, that may or may not happen. Back to your question about important events in the fixed income market, I would take us back to Jackson Hole, where the shift in Powell's tone from the focus on inflation to the other mandate that the Fed has is ensuring maximum employment. That's really come to the forefront of all the narrative on all the the TV shows and all the investor narrative. The focus is all on the job market right now, and tariff inflation has really been pushed into the background, which is unfortunate but it may lead to opportunity. But this jobs number is, everyone's saying it's, hypercritical, et cetera, as Ken rightly pointed out, 90% probability, a 25 basis point cut. Powell basically said as much at Jackson Hole. But interestingly enough, the forecast out to the end of 2026 are for 5 cuts. Given the Fed funds rate, 4.25 to 4.5, they have lots of room to cut. Whereas in Canada, we are, close to the bone, as they say. There's not a lot of room to cut. And I'll just end off on, Dave, I think you mentioned about the currency moving sideways. I might push back against that a bit and say, look out below. Like, I think the Canadian dollar doesn't have much support here. And with falling oil prices, I don't know whether the Saudis have held their meeting or not, where they're going to pump up output, but this Russia-China agreement on, buying all their oil, I think, oil could go significantly lower, and that's, really bad news for the Canadian dollar. So I'll end there.
Any thoughts of changes at the Fed, or will Trump truly control the Fed come next May, or what? Or this May, I think. What are you thinking next May?
Yeah, I guess the this lawsuit with Dr. Cook, I guess is her proper title, is pretty critical because that speaks to the how much political influence can go into the Fed. His replacement for the woman who resigned abruptly is today. So, I expect he'd get a pretty solid grilling.
But on that Jones lady, isn't there evidence that she created mortgage fraud and Powell should have fired her already anyways?
Yeah. Cook, I think, as you rightly pointed out, her argument seems a little weak, saying that the fraud or the inconsistencies were on my original documents, so you guys should have noticed it then, which is perfect.
What's that you said?
Weak defense, and the Fed has sort of stepped back, saying, we're just gonna whatever the courts say, we're gonna go with that. Yeah, I mean, the direction of rates is down, I think, at the short end, which is going to lead to definitely, I think, a Fed policy error if tariff inflation comes into play. Certainly negative real rates, which may make that Goldman forecast look pretty accurate. Great for gold at negative rates. And the whole process of a new chair. I mean, if Bessent picks a new Fed chair that's outrageously dovish, that's another factor to continue or to consider. I mean, I think the direction of travel is definitely lower rates and a more dovish Fed for sure. I mean, I just think that's kind of sort of overwhelming. I think Waller did come out, who's kind of, I think, the leading candidate and pretty well respected. He said, we don't have to cut every meeting. We soften it a bit by saying we may cut every other meeting, so bit of a concession there to the Hawks. But I think at the short end, the direction of travel is definitely lower rates for sure. And but obviously, as has been pointed out a couple of times, the very long end of the curve is not buying it; it's going up, and that's a worldwide phenomenon. Like all the curves, even Japan, the long bond in Japan hit a record high. So I think it's sort of a worldwide phenomenon that this gone is the days. I'm sure, Dave, you remember when the Soviet Union imploded and Clinton was running around talking about the peace dividend and how it's going to be great for the deficit. We don't have to spend on war. Well, I mean, Biden and all these guys have been riding the peace dividend for decades now. And that dividend is done, and Trump's going to make sure of that. So I think that's what the long end is seeing, that, there's no more peace dividend. It's spend on defense, et cetera. And, it's they're going to have to ramp up even more with, China. I forget the three figures there were China, Putin, and the Indian guy. So that's a pretty formidable force against the U.S. So, NATO's got to get its act together and start spending on defense. And, no question they can do it. But, what's the cost, right? The long end saying, you got to pay me more.
Yeah, that's okay. Well, thanks for that. There's Michael Coolbaugh's weekly observations just came in. So I will do that really quickly here, and then we'll wrap this up. Michael Coolbaugh is a macro analyst that we have some money with, been doing quite well. And so just some more data points of the market. Growing momentum divergence. Each push higher has come on weaker and weaker momentum. These creeping rallies tend to lure people to sleep before a sudden turn. Okay, here's something on the VIX. We continue to churn around the 10 times level, which is typically associated with complacency. And remember, the point and figure measured it up to almost 30. So we shall see. CTAs maxed out. Extreme positioning in CTAs means that a mindless bid will begin to dissipate. If the trends flipped, there's a lot of de-risking to be done. Growing signs of a soft patch. Labor related, so unemployment moving up. Find out tomorrow. Anticipating tariff pressure on consumers. Yeah, this is not really showing up yet in true inflation, and just getting through to the consumer or not. So that's got to be coming around the corner soon. SM survey responses. Yeah. So everything that we've been talking about. Yeah, trucking industry continues to contract. That doesn't come up very much. Home building remodeling, not very active at all. Yeah, so some things changing there. Copper a gold ratio. One of the oldest barometers for economic health has been in steady decline since 2022. Copper gold ratio supports the soft patch theory. Okay, so tougher economy according to that. Okay, the UK 30-year yields up at 5.7%. A cautionary tale for the US, begging to slash rates with persistent inflation. I'm not sure if the UK did that. I know a number of years ago, Turkey was doing that, and it was a disaster. Anyways, I guess that's it. Okay, thanks everybody else. We'll talk to you later.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.